All right, let's look at Opendoor Technologies. The U.S. markets are, of course, closed for the weekend. As of the closing bell on Friday, November 14, 2025, Opendoor finished the session at $8.12 a share. That was a tough end to the week, closing down 44 cents, a significant drop of 5.14%. Now, the immediate reaction, the expectation, when you see a 5% drop in a name like Opendoor, is to immediately blame the housing market. The common narrative is that this is just an iBuyer, a high-tech house flipper, and its stock must therefore be a simple proxy for housing prices. But the reality, what the trading patterns from this past week truly illustrate, is that Wall Street has almost entirely stopped trading Opendoor as a real estate company. That 5.14% slide wasn't a reaction to new housing inventory data. It was a violent leverage reaction to fluctuations in the bond market. The stock is currently behaving like a high-risk financial derivative, completely tethered to the 10-year Treasury yield. And that's the crucial insight that many investors, especially those doing self-investing or just checking their Robinhood app, are missing. The expectation is real estate, but the reality is leveraged finance. The common ground we all share is that Opendoor's model relies on a functioning housing market. The idea is simple. They use algorithms to make cash offers on homes, buy them, perform light maintenance, and relist them, capturing a fee and ideally a small profit for the convenience. In a stable or rising price environment, this looks fantastic. But that's where the common understanding stops, and it's a flawed perspective. The deeper analysis, the one that institutional desks are trading on, isn't about the spread they make on the flip. It's about the cost of capital to hold the inventory. This is the friction point. Opendoor doesn't just buy a house. It borrows immense sums of capital to do so. Every single day they hold a property, that property's financing cost eats away at the potential margin. This is fundamentally different from holding NVIDIA stock, which is a bet on processing power and AI adoption, or even Apple stock, which is a bet on a global consumer ecosystem. Those companies create value over time. For Opendoor, time is the enemy. Their inventory is a depreciating asset in real time. Not because the house is crumbling, but because the debt service on it is compounding. This is why that 5.14% drop on Friday was so sharp. It wasn't an isolated event. It was the capstone on an incredibly volatile week that saw the 10-year yield tick up. The stock tested support near the $8 psychological level several times, and Friday's high volume break proved that support is fragile. The volume was critical. It was roughly 140% of the 30-day average. This wasn't retail panic. This was institutional de-risking. When you see block trades of that size moving on a macro twitch, it tells you the big funds are treating this name as a risk-off asset, dumping it the second their cost of capital models flash red. This dynamic makes Opendoor an incredibly difficult holding for the average person building a portfolio, perhaps using Schwab Intelligent Portfolios or a SoFi robo-advisor. Those platforms are built for diversification and long-term holds. Opendoor in its current state is a short-term macro trade. This is where the choice of brokerage and tools becomes so important for anyone looking to engage with this kind of volatility. Someone using the advanced option strategies on the Interactive Brokers trading platform is playing a completely different game than someone buying fractional shares on Robinhood. The Interactive Brokers user might be buying puts as a hedge against yield curve steepening, while the SoFi Invest user is likely just betting on the long-term brand, unaware of the daily financing pressures. The tools available through different platforms, like Fidelity Investments or SoFi, can shape your perception of the investment. The Fidelity trading platform offers extensive research, which, if used correctly, would highlight these balance sheet risks. But if you're just looking at a simple chart on the Fidelity mobile app, you'd miss the why behind the drop. You might see it as a buying opportunity, when in fact the fundamentals just got worse. This is why context and investment help are so critical. It's not just about online investing. It's about understanding what you are really buying. You're not buying a portfolio of homes. You're buying a highly leveraged bet on the direction of interest rates. And the competition is watching. This isn't just Opendoor's problem. The entire iBuying sector, which includes Zillow and Redfin, though they have different models, is under pressure. But Opendoor is the pure play, the one with the most balance sheet exposure. When the sector gets nervous, Opendoor is the first to be sold off, and it's sold off the hardest. This isn't the kind of stock you just passively park in your Fidelity IRAs alongside Fidelity mutual funds and expect it to compound. This is an active, high-intensity holding. You need to be monitoring it, perhaps not just on investing sites, but through real-time data feeds, which platforms like Interactive Broker stock trading provide. So let's briefly touch on the business model itself, because it's key to understanding the past and the future. Opendoor effectively acts as a market maker for single-family homes. For a seller, it offers certainty and convenience. You get a cash offer, you skip the showings, you pick your closing date. In exchange, Opendoor charges a service fee, typically around 5 to 6%, which is competitive with traditional agent commissions. They then turn around, clean the place up, and try to sell it fast. The whole model is predicated on volume and speed. This all came to public attention during the SPAC boom, when the narrative was all about disrupting a massive, archaic industry. The stock soared. But then 2022 and 2023 delivered the ultimate reality check. The Federal Reserve hiked rates at the most aggressive pace in decades. The housing market, which Opendoor's algorithm was trained on, a decade of near uninterrupted price growth, seized up. Opendoor was caught holding the bag. They had overpaid for thousands of homes at the peak and were forced to liquidate that inventory at massive losses, resulting in billions in write-downs. That 5.14% drop last Friday wasn't just a drop. It was the market's PTSD flaring up. It was a terrifying echo of that 2022-2023 disaster. The market is now hypersensitive to any sign that their algorithm is mispricing risk or that their holding costs are getting out of control. This isn't a speculative growth story like Tesla stock anymore. It's a survival story. Looking forward, the entire bull-bear case for Opendoor is stretched between two extreme scenarios, a perfect example of expectation versus reality. The expectation is that we have seen the peak in interest rates. The hope is that the Fed begins a cutting cycle, mortgage rates fall back to a reasonable level, and the housing market unfreezes. In that world, transaction volume explodes. Opendoor's algorithm, now supposedly smarter and more conservative after its near-death experience, can finally operate in a normal market. They can process high volume, manage their spreads, and the model could finally scale profitably. In that scenario, $8.12 a share looks incredibly cheap. The bulls are betting the lesson has been learned. But the bearish reality is much darker and, frankly, just as plausible. What if rates don't get cut? What if they stay high or even go higher to fight persistent inflation? In that case, Opendoor's financing costs will continue to strangle its margins. Or, the other nightmare scenario, what if the economy tips into a recession and we get both rate cuts and falling home prices? If home prices fall faster, then their algorithm can adjust its buy box. They will be right back in 2022 buying homes for $400,000 and forced to sell them for $350,000 a few months later. Their balance sheet cannot survive another round of that. This is why the stock trades at such a low price-to-sales multiple. The market is pricing in a significant probability of failure. This is a critical point for anyone doing online investment or managing their own individual brokerage account. The risk profile here is extreme. This is where I want to hear from you. Comment below what you think is the single biggest catalyst that could save Opendoor. A 100 basis point cut from the Fed, or a 20% surge in existing home sales. Let me know your thoughts on that. This is a company that has to prove itself in a neutral or even a difficult market. The platforms we use to trade this name, whether it's the simplicity of SoFi stocks and SoFi ETFs or the complexity of an interactive broker's account, are just the tools. The thesis is what matters. And the thesis for Opendoor is on a knife's edge. This isn't a stock for a Fidelity wealth management client looking for stable growth. This is a stock for an active trader, someone who watches the bond market as closely as they watch the stock ticker. The rise of Robinhood stock trading and Robinhood crypto has brought many new people into Robinhood investments. But a name like Opendoor requires a level of analysis far beyond a simple buy the dip mentality. So